Today we're going to talk about something which you cannot avoid not talking about, which is the
Magnificent Seven.
Magnificent Seven. Exactly, Casper.
We're going to talk about those 7 most important stocks from this moment.
Correct.
A little bit background information. CNBC personality Jim Cramer in 2013 he invented the Vang shares. And then 4 years later, he made it the Fang with a double E in it, and he contributed Apple. He added Apple to it. Only last year, so 2023, an analyst of the Bank of America, Michael Harnett, he began to mention the saying, the Magnificent Seven. And the Magnificent Seven is based on a Western from the 60s. And I think they made a retake in 2016, I believe. And what are the Magnificent Seven and how important are they nowadays, Martin?
Well, the Magnificent Seven, it's 7 stocks, as you can understand. It's Apple, it is Microsoft, Amazon, Netflix, I was going to say, but not anymore because that was part of the Fang. It's Nvidia, Google, Meta, and Tesla. So those 7 stocks, and they present not less than 31% approximately of the S&P 500 on the 31st of December. It might be even a little bit more now because the market is higher in the last month of January.
With the good results of Meta.
So Meta might have, and they also swap places sometimes. So the remaining 493 companies of the S&P represent 70%, and though 72% on the 31st of December. And they were not small companies. And even the company number 500 is a company that is worth billions. So you see very clear also in the picture how these market caps of these companies has been going up. So it's not something that is happened just over there. Since 2017, it's been literally one straight line up, just as the S&P 500 itself. You see a small dip in COVID, of course, when the market cap dropped a little bit, and then boom, where we are now. It's 30%. You see also the profit margins of these companies going up quite significantly.
So 7 companies are good for more than 30% of the S&P 500.
It looks a little bit like the IBEX 35 with only 35 stocks in Spain, and there's only 3 or 4 that.
So if you want to create a vision on S&P 500, you should first create a vision on the Magnificent Seven. We will discuss all those 7 shares here, and we do it from all the angles: technical, fundamental, and some other angles. And we start with the A, with Alphabet, Google. I'm not going to mention all the figures that are in front of me, but it's trading at $145. And based on the expected profit per share for this year, the price earning is 21. And all the shares have higher expected profit this year than last year, and all the expected profit of 2025 are also higher than 24. And based on the profit per share, it will be 19 for 2021, and that's not a lot compared to the other 6.
No. What about the debts?
The debts, all the companies have low debts in relation to the assets, and not related to the cash flow, to the revenues, but to the assets. 475 of debt of assets and 13 billion only of debts.
Okay, so what I've done is I've looked at the price targets in the market. So if we look at Alphabet in this case, they have a price target of $161, which is 9% above the current price.
That's for 1 year, eh?
It's also for 1 year, And then I took the Benjamin Graham model. Benjamin Graham is known to calculate the intrinsic value of a stock based on earnings per share, growth rate, the interest rate on a AAA corporate bond, and some other ratios. And it gives an intrinsic value of 297. At the moment, the stock price, as I mentioned, is 146. So you're buying it pretty much below the intrinsic value. Interesting, I think, from Alphabet in this case. Technically, the stocks have, all these 7 stocks, as it will not surprise you, we looked at the RSI, it moves between 30 and 70. 70 is overbought, 30 is oversold. They're all at 70 or slightly higher or lower. So I'm just saying what is coming up with the technical analysis. And all of them are overbought.
One step back. Jim Cramer that I just mentioned, the famous journalist from CNBC, was always yelling and screaming in the screen. He looks a little bit, no, he doesn't have a beard, no?
He's got a mustache.
Yeah.
Why he looks like me? Because he's bald?
No, and a beard, I thought. Yeah. But he earns So we can also decide to apply for a job with CMC. He earns $5 million a year.
Maybe we should start shouting a little bit more.
Yeah, and his wealth is around 150 million. Okay, next one, Amazon.
Money with what? With stocks, no, I suppose.
Sorry?
He made his money with the
Yeah,
stock
he was a
market,
hedge fund manager.
Yeah.
Amazon, much higher figures, so less interesting from that perspective. 47 PE for this year, and that will drop if the profit growth will, if they will make it 35 for next year. 605 billion of assets versus 52 billion of debt only.
Yeah. Look at the price
Amazon.
target of Amazon. Amazon you're talking about.
Yeah,
Amazon,
already.
the price target of the stock is at this case 205, and that is out of the 7, the one with the highest expectations in price increase, about 21%. We look at the model of Benjamin. He has a intrinsic value for us of 156. Current stock price is 171, but he always says you should buy at 65% of the intrinsic value, so you should be buying Amazon at 101. So in this case,
A little bit lower.
it's a sell. Yeah, next one.
Apple, not that expensive, 29, the forward PE, and it will drop a little bit to 26 in 2025. And they have the highest ratio in relation to assets versus debt, 376 billion of assets versus more than 100 billion of debts nowadays.
Yeah, so a little bit more debt for Apple here. The price target is 201. That is about 7% above the current price. If we look at Benjamin Graham on Apple, he has a price target of intrinsic value of 187. You should buy at 65%, and that's 122. You're buying the stock at 188. If you just want to buy it at the intrinsic value, you're on the spot. That's where we are at the moment.
And Meta, that's the fourth one, it gained 20% on the figures. So with the new share price, it's trading now around 470. Still, it has a low PE. I think 27 for this year and 23 for next year.
Low, yes.
Even after the big jump, after the good, the great figures, and the ratio is fantastic, 282 in assets and only 20 billion
Very
of debt.
small amount of debt. If you look at the price target of Meta, yeah, it has a buy consensus, as we can understand, as they all have. $490 price target, which is about 4.5% above the current price. If we look at Benjamin's model, yeah, and this is I double checked it. It gives you an average price of an interesting value of 1,108, and that is
Excuse me?
1,108. That's the interesting value of.
It's double the price.
Double the price, yeah. And like I said, I checked the formula. It's based on the growth rate, of course, and the enormous earnings per share. So the price of Meta, could, based on this model, go up quite significantly. Because the acceptable buy price is $720, where you're buying it at $469. So you're buying it bloody cheap.
Microsoft, of course, also jumped after the cloud service and the AI services, of course. JetGDP announced today, is not official because it's not public traded, 2 billion of revenues from the JetGDP last year, so that's also contributing to Microsoft. Higher PEs, 36 for this year and 31 for next year.
Yeah.
And the ratios as a debt 497 versus 74, that's also very nice.
Absolutely. Looking at Microsoft price targets at 452, so that is 9.5% above.
Still, that's still
There's
high.
quite a lot
Yeah?
of potential, 9.5% above the current price. We're looking at technical, well, we know, as I said at the beginning of the first chart, also overbought here. But we look at the Benjamin Graham model, what we can see here is a intrinsic value of 450. Current stock price is 440, but you're looking at 65% buying, so it's 292. If you just look at the intrinsic value, you're buying it below the intrinsic value. So even though my model says a sell here, doesn't mean that you cannot buy it, because it's still below the intrinsic value based on the current figures that we have.
Nvidia.
Nvidia, yeah.
Everybody talks about Nvidia. It's a price earning for the expected increasement in profits for this year.
Yeah.
Still, if that comes true, you pay 57 times the profit.
Yeah.
And that drops if they can met the goals of 2025 till 34 times the profit. So this, from that perspective, it's the most expensive one. Debt and assets, nothing going on. So what does Graham says?
Well, and the price tag for Nvidia in the market is 660. So that is actually the only one that is negative. So
yeah, because now
we're trading
it's
above 700.
Yeah,
So it's 5% below the current price. However, if you look at Benjamin, and that is only and because of the fact that there's a huge growth rate for the next 5 years, and the growth rates you pick from a Yahoo Finance, or you can also calculate it yourself with your trading platform. This is 102% growth in the next 5 years, and then that combined with the earnings per share of 21, yeah, it gives you a price of 4,232. And I checked it, double checked it. That is the intrinsic value of Nvidia, which is tremendous, of course. If you take it a little bit to normal standards, so because they say the growth rate has been maintained by Benjamin Graham is outdated. So you lower the ratios a little bit, you get to an acceptable buy price on intrinsic value of around 2,000.
And it's trading at 700.
700. So if they manage to grow with 102%, well, and you're buying then it's slightly above the intrinsic value, which a lot of stocks are trading, yeah, then it's not impossible, because if it grows indeed with 100%, 1,400 is the price, no? 700 to 1,400, and then if you buy it a little bit above the intrinsic value, because maybe they keep growing in 2040, yeah, then 2,000 is maybe not even impossible.
Tesla, the last one.
Tesla.
Different chart
Yeah.
over the last period.
Absolutely, yeah.
Still expensive, 62 times the profit, and 45 for next year. They have hardly no debt, only 5 billion, and assets of 121.
Yeah.
But I said another chart, so I'm really curious what the other angles say.
Well, Tesla target price 207, so also about 9.5% potential there. But as you say, the chart looks different. And first of all, let me look at Benjamin. Benjamin gives it a $77 intrinsic value. Yeah.
And it's trading out 190.
190, so you're buying way too expensive. There's a huge difference there. If you look at the chart, it's oversold actually. It's around 30, so it's at the bottom of the RSI range. Interesting, eh? So it's
conflicting signals.
Yeah, a lot of conflicting signals here. Absolutely.
And an investor wants to have that all the lights are green. So this, if you are from a technical perspective, you can buy it. But from a fundamental perspective, not.
No.
So that are the magnificent 7.
Yeah, so
really important. And if you want, everybody is talking about it, and you see how important it is, and there is still a lot of music in it.
Absolutely.
And a lot of potential in it. There is only one ETF on the market now that only invests in those 7 stocks. It's the Magnificent 7 ETF. You only can buy it if you are living outside of Europe, or when you're a professional investor, because it's an American product and they don't provide European necessary information. But within 1 month, we don't do any expectation, but we do expect that a lot of ETF builders like iShares and Van Eck will come on the market with an ETF for the Magnificent 7.
Yeah, and I think to round it off with, if you look at those 7 stocks, of course, they have outperformed the S&P with 163%, which is, of course, tremendous. But based on
S&P 500 was already good.
Yeah, S&P was already great. But if you look at their exposure to what is now hot, artificial intelligence, cloud computing, all that sort of things that you read any financial newspaper a lot about, yeah, they're very well positioned. So I don't see any dark clouds as we have today for these companies.
They're all cloud services.
Cloud services, and they look white. So
keep it in consideration. Take it in consideration. Thank you for watching. Give us your time.